guys, if you are in the real estate investor syndication space, then listen up because there's some recent tax changes that have just come about that's going to be beneficial to you and your investors. So the year right now is 2025, and Congress recently passed the One Big Beautiful Bill that changed the tax treatment for how some real estate syndications are able to deduct their interest limitation. Now, if you're just a real estate investor who has maybe a few active partners and are not in the real estate syndication space, then this doesn't apply to you because there is a $30 million limit and an exemption for active real estate investors where you can deduct all the interest you pay on your mortgage and it really does not affect you in any limitation. However, the IRS has put rules in place for real estate syndications that have passive investors or limited partners, and if they have more than 35% of the passive losses passed on to their limited partners, they're considered a tax shelter, which means that the IRS has put in place some guardrails where they can't deduct maybe all of the interest they pay on their mortgage, and they're subject to a limitation on how much interest they can deduct. So what has changed is the amount that the syndications can invest because they changed how that calculation is done. So previously, the calculation was done on earnings before interest and taxes, but did not take into account depreciation or amortization. So that has now changed because they added in depreciation and amortization before you would calculate the limitation for how much interest deduction you could take. So this is really beneficial because now you will probably be able to deduct much more of the interest that you're paying on your mortgage without being subject to that limitation. And additionally, when Congress changed some of those rules, 100% bonus depreciation was also brought back again, which is great for all real estate investors, but also you can do a cost segregation study as a syndication, pass on that benefit to you and your investors, but it also increases the level of income, or basically the calculation before you're subject to the interest limitation. And that is another big benefit as well of layering the cost segregation to the business interest limitation. So if you are in the real estate syndication space, make sure that you pay attention, understand those rules, consult with your tax advisor, of course, because we're not providing tax advice, but you can pass on a lot more benefit in cost segregation to your investors and potentially provide greater returns to your investors because you're able to deduct more of your interest. That means you might be able to bring on more investors as well because you're providing them more of a benefit, a greater return. So now is a great time to gear up as an investor because you're going to be able to provide more value to your investors as well as you and yourself. So if this video has brought you some value, please like, share, and subscribe. And if you're looking for real estate in Pennsylvania or Maryland, please reach out to us. We're happy to help. I'm Naomi Brown with Capstone Commercial.